Good morning, everybody. Welcome to Daily Plan. Somehow I'm not hearing things. Let's see what happens. Okay. Might be having technical difficulties here. Let's see. Whoa, looks like something happened here with the CPI. Holy moly. Can you guys hear me?
I can hear you.
Okay, I can't hear you, so it's probably going to the wrong device. Yes, it's going to my headset. Okay, that's better. Look. Testing. Can somebody speak so I can see if I can hear them?
Can you hear me? Test, test.
Whoa, yes. Okay. Sorry, guys. Okay, so apparently they like the CPI. I don't care what it said, but it said something that somebody liked. So we ate right through the top of the chop zone, which you see here. Doesn't mean we're going to stay here, but 7,000, they had it in their eyes a long time. Not to toot my own horn, but I will. I was saying 7,000 in October and November. By the end of the year, by the end of December, oops, I was off by 13 days. Considering we're talking about a 2-3 month window, we'll call it a win. Anyway, I still have a few of those trades open, not many, but a few. Anyway, so let's get to where we are, and we're also going to do. I'm going to do a quick recap of yesterday, because yesterday was an interesting day. If I could find it here. Actually, I'll come back to the recap later. Maybe when vol traders come on, because we were talking about it. But the brief version of the recap of yesterday. Let's see if I can find a way to show you this. I'll come back to it because I want to show you screenshots and I don't have them prepared. Anyway, so we closed up right at near 75, a new all-time high, about a little bit away from the gamma wall. Now, according to the technical analysis breakout guru official playbook, 2 new all-time highs in a row is confirmation of whatever, of the trend or something. Last time we had that was in October. So now doesn't mean that we go straight up from here forever. We can easily pull back, but it's confirmation of the breakout if you worship at that church, if you're technical, whatever. Other stuff, and this is kind of old school market stuff. Breadth has stayed constructive. And, I guess I'll say for myself, this is in addition to the gamma, and to everything else, looking for as many areas of confirmation as we can get. Breadth has been constructive. Now, cumulative volume breadth, which is breadth, but not just advances and decliners numbers, but volume of the advances and decliners, was even more bullish. So not a one-stock parade, not this many up, this many down, but the volume doesn't really make a difference. Term structure is constructive. We have a nice sloping term structure, although VIX is a little low. People get nervous about that. And it's really not something to be nervous about. I'll let you know when to get nervous, and now's not the time. You know when I'm nervous. You can get nervous whenever you want. Now, CBOE adds a twist. Let me see if I can find this. Actually, I'm not going to bother digging it up. It's going to take too much. So if you go to the CBO website, you can subscribe to Mandy Sue's weekly CBOE options, whatever you want to call digest, like, 5 to 10 page, like what they saw in the options and in the VIX. It's a volatility digest, what they saw in the VIX. So long story short, I believe their data. They probably know what they're talking about since they're the ones that sell it and made it up. Investors sold calls last week and bought puts, steepening put skew a little bit. Now remember, skew is relative. It doesn't matter if the put is, how expensive it is. It's how expensive the 10 delta put is relative to the 25 delta put, not off of some other standard. VIX is math, all this stuff is math. And so that said, last week, and again, it's not shocking, customers bought 10 delta puts, out of the money puts. They bought wingy put stuff rather than 25 delta puts, one standard deviation, out of the money. I'm expecting a pullback kind of puts. And so that's what customers did, and it kind of makes sense. So now the good news is that tail premium is rich. They overpaid for it relative to prices now, which could pull us up. However, on the other hand, if we get some weakness, that could push us down. Potato, just kind of depends how things play out, conditional. Also means those wingy puts are kind of a little juicy to sell, and you can create some, multi-leg structures, taking advantage of that and taking advantage of the cheaper 25 delta near the money puts out in time. This isn't like a 0DTE thing. It's like a into February thing. So if you're bearish, if you want to hedge. Anyway, so here's, the 1 month put convexity 10, jump from the 25th percentile to 72nd percentile. This is all just numbers I got from the CBOE that I thought were important. You can get them too. I just threw them in here for fun. And in the server, I think I might put some fly ideas. I'm not sure if I put them in, but I know I modeled them out. Okay, so here's one variation of my of one of my volatility dashboards, and let's go to it here so we can play with it a little bit. Here we go. So I put this one in today because we're talking about dispersion. I don't have the dispersion index in here, but dispersion and correlation are really low. So lots of stocks are moving around independently, rotating. But that also means call buying and straddle buying in individual names, selling index options volatility against it, which works great, compressing volatility until it doesn't, until things break. So I'm not saying that things are going to break. I'm saying that when things start to look a little stressy, hopefully I'll notice it. Hopefully you'll be listening when I let you know, and hopefully I'm right. So we have a few hopefullys there, but I'm just going to be honest with you. This is kind of, I don't know if I got the right futures contract on here, because 17.9, that doesn't look right to me. And VIX puking to here, so something looks funny here. I don't know. So the VIX trades off of this, settles the VIX settles into this contract in January, and this 4-point divergence doesn't make sense. So let me, I'm not sure what it looks like. I'm looking at the right contract, but whatever, I'll check that out later. VVIX, all the VIX volatility metrics were fine. I think what happened yesterday, though, by the way, I don't have the screenshot here, and rather than dig it up, we had that pullback in the overnight session. Volatility popped. Those puts got expensive that people had bought remember when skew was at the 25% last week. Market makers hedged right down to 69.10 where the long puts were. We got above it, and then we had lots of chunky puts right near the money. Volatility came in intraday, nice volatility coming in. Those puts evaporated. That pushed us up. Then once we got over whatever some of the levels were, customers came in, started buying calls, traders buying E-mini futures, whatever happened, party on Garth, and we just kind of took off yesterday. That's kind of my short version of what happened. And as is typical, let me go, I'm already here. Let's go back here for a second because I think this illustrates something. And I mentioned it in my note. So what happened? Initially, some of the volatility got sucked out of the surface. The unknown, the CPI, became known. So whatever hedging the market makers had to do for whatever near the money options there were in a short time frame, now the volatility is down. The delta of those puts goes down. Market makers have to buy back some of the shorts and recalibrate their hedges. Then we go up, and so that's what happened here. So that's what happened here. And now things are kind of settling back after that initial hedge. There's no grand conspiracy. They, the Illuminati, didn't bring it up here to make you buy it, to trick you, to sell it to you, whatever. There is no ghost in the machine. It's just math. That's all it is. But anyway, if you want to believe the Illuminati did it, then you can believe that too. And so now we're kind of coming back into the chop zone. We'll look at why that's the chop zone in a minute. And now we, and now we have to see what the algos think, quote unquote, when the regular session starts. Okay, so let's get to here. Actually, let's do it on my notes. What you guys were seeing here is, whoop, that's not it. What you guys were seeing here was this from my note. And so here's the zone. So right now we're at 85, right here. Big positive gamma. Now, this is options that platform, by the way. And just as a reminder, I got 4 comments here. Just as a reminder, bars to the right are market makers long, customers short, customers sold 69.85 calls. They sold them. Actually, these were here yesterday. I think that's part of why we stalled here yesterday. So here's the broad zone we're in. Really broad 6900, 6910 to 6985. But really the playground is here, 6950 to 6985, with the bars to the left being where market makers are short options, customers are long, and those tend to accelerate into the move. But then as soon as the move kind of slows up, it kind of reverses the other way, but then goes down to here to bounce, because we bounce off of these levels. If they're above us, we bounce off this way, then get sucked back toward them. And the same thing in the other one. When you have a ladder like this, if over 85, we have a ladder to 7,000. If we get over here and stay over here, that's not that crazy, And I would suspect some of the hedging we saw was hedging that ladder. On that block. And then over on top here, 67, 10, 20, whatever it is, there's one more cluster of like stall area with this little thing at 70, 10, 70, 15, you never know. That's outside the expected move. The expected move was about 30-ish when I checked in the morning. And so from here, 30-ish would take us there. I'd have to check the expected move when we open. But so 7,000 is in play, 6950 is in play at the bottom. And then if we fall into this sticky thing, it would kind of take something to kind of break through this volatility to pop for some reason. customers to close things out, something. It takes something, especially to break down to 69,000. Let's see. And here's the game plan. So volatility, so skew steepening higher, put convexity markets paying for left tail. But index vol stays contained. Low implied correlation, rising single lane vol, earnings dispersion season. Let's not forget that. That's part of why that's happening. You get, institutions, not me, I don't know how to do this fancy stuff. The algos are buying straddles or whatever they're buying on for the earnings and funding it with selling index vol somehow. And then the CPI here, volatile, watch the CPI initial vol drop deals rehedge can create initial clean first move, while 2 hits when the algos reprice it out. So it's in my note in case I forget to mention it. That's basically it. Okay, so here's that same options depth thing. And let me see if I could do a quick replay of yesterday, what happened. I'm going to have to look in my Discord, in my commentary section. We also have, do regular stock stuff too. We have some people that do stock stuff. So, all right. So, yeah. So let's replay yesterday. So yesterday in the morning, see this 69.20 and lower? We had all these puts there, and we were kind of playing around over here. We undercut right down to 69.10 in the overnight session. And then we were when we opened near 30-ish, I think. So we opened above this, kind of pulled back a little bit, and then this decayed. Whatever hedging that the market makers had for these puts, they're slowly releasing it. We're going up. I thought we might get to 50, 45 new all-time high, maybe to 60, a bridge too far. But we did have this ladder. Pulling us up. Okay, now something else I want to show you. I don't know if I put it in there. I didn't put it in there, son of a gun. Because the other thing that happened later in the day was some of the, here you can kind of see it. Some of the sold calls up here that were acting as a wall at 75 and 80 and 85 got bought back. Whether they got bought back by the people that sold them or QE came in and bought 10,000 calls. I'm not sure what happened. I noticed he was busy during that time, and it ate through the wall and kind of created this path up, and it weakened the wall over there. So I'm pretty sure I was making a comment to my subscribers in the Discord there when that was going on. And we see all this kind of supportive stuff over here. So that's okay. So anyway, that's kind of what happened. All right, so I'm gonna turn the mic over to Julie. I'm gonna put E-mini up here. He's a futures guy. I'm gonna let Bad Hombre take it away. Go ahead.
Trying to find my window here to share. Just 1 second, guys.
I just want to point out that some of us were looking at the setup yesterday and looking at potential flies over there at 7,000. And I'm really, I don't know if proud's the right word, but yeah, I'll say proud of Selena. She's been diligent, writing a daily plan every day of her own, and been learning this option stuff and actually teaching it to some people, learning some of the nuances. And that really brings me joy to see people, putting in the effort. You know, it takes effort. You know, what can I tell you? Anyway, go
It
ahead.
does. Yeah. Yeah. So good on you there, Selena. Guys, the first thing that I was looking for was a push up into my reject zone here of 7,025. It happened before pre-market, or happened during pre-market. Kind of ruined one of the trades I was really hoping for. But now that we have done that, I am looking for the break below my pivot at basically 7,000. If we can break below, I think we can get ourselves a nice 15-point move to the downside. Um, and here's the thing: I'm expecting a bounce in this general area, but if the selling is too aggressive, I'd be pretty interested in targeting the 69.75 area here. If that selling doesn't look like it's weaning off. Pretty simple kind of game plan that I'm looking for here, but this bounce zone, I'm going to remove it, as I think that we've already had the bounce I was expecting from it. So just be diligent. I think if we can have, I would say a 5, maybe 2 5-minute candles close below 7,000, I'd say it's a pretty safe trade down to for at least 10 points on ES. If we start to hold up here and then we come back above pivot, I would then target the 7,047. It could get pretty aggressive today. I'm going in there without a bias necessarily directionally. But I do think we're going to have some fun trading whatever level, whatever direction comes out.
Okay. Okay. Well, vol trader, what you got for us?
Hi, good morning. Do you hear me fine? Do you guys hear me?
Yeah, I can hear you fine.
Yeah.
Okay. So, first of all, yesterday I think was an interesting day between the data and what actually happened. Myself, I wasn't that bullish. Actually, I was positioned more to the downside. The data on my end, my analysis was pretty bearish. But they managed to squeeze out all the shorts and do what they do. And then the overnight came in and rebalanced that a bit. Now we had this CPI that, as of now, seems a bit to fail, but pretty early. I don't know if they tagged the 7,000 on the SPX here on the for the CPI, if they tagged that as a prediction to where the market is going, or rather than they actually pushed it higher and really got sold off. Too early to say yet. So for today, what I have, I'll share the screen.
Look, it looks like we hit 99. It looks like we hit like the equivalent of SPX 99, give or take.
Yeah.
Which is not shocking that we've seen this a million times. Go ahead. I'm sorry for interrupting. That's funny, you know.
Yeah, but still early to say. The setup for today was pretty clear, bullish, much less confusing for me than yesterday, but still, I see 7,025 as max level for the upside today. And 7,000 was pretty much in the cards, and I think it was in the expected move. But we'll see how this works out. Anyways, I'm going to share the screens. 1 second. Okay, I'm sharing my screen. Doc?
Okay, let me find. There it is. Okay. Let me go. I have to get mine off. Hold on.
Yeah. So first off, with the open interest layout, a clear transition level, which we were hovering all morning, overnight, there, 69.70, 75. So clearly becoming call dominated in a big way above that level, specifically above 69.80, 69.85. You can see there are only green bars at the bottom chart. Expectation wise, market has pretty much 100% chance to tag the 7,705 or something. That's pretty much in there. To the downside, we can see that they priced in a similar odds to 69.50. So this means that we'll check it in a minute, but this probably means that into the CPI from yesterday, they elevated the at the money volatility. When we look at the micro skew, we'll probably see that. So they gave a similar odds up or down, 50 points or so, which is kind of natural to how the CPI works. But it's pretty, I mean, as long as the market holds this 69.85, if we hold that, as long as we hold that, the market can only go up into heavy positive gamma with all those dynamics, but very bullish all in all. And we do have the two most concentrated open interest levels are 69.85 and 7,000. We can see that on the right portion of the screen, where you can see the dark greens kicking in. That's 7,000, 69.85. So we see those levels as support as long as we're above them. Now, if we look a bit deeper into the data, 1 second. So looking at the micro changes of how market makers were forced to price the skew into the close yesterday, this dark blue line, which goes from left to right, that's the skew. And you can see that it's pretty elevated around 69.50, 69.70. You can see it's pretty elevated towards these 2 points, which are lower. This 730, which is the trough, and this one here at 6,900, which is also a trough. So you have like an elevation in the middle, which is kind of what I expected in terms of what you would generally see before a CPI move, right? Now to the upside, pretty clear that up to 7,025, 7,030, market could try and reach those levels if it's really bullish. And then you have a drop off in interest. There are no green bars, no black bars, no red bars, anything else above that. So that will act as strong resistance into an already exhausted move in my eyes, if we were to even get there. To the downside, what I'm seeing is 69. So to the downside, we have 69.40 as I see it as main support. And so if we were to go down there, which I doubt kind of as of now, but if we were to go down there, we'll probably get that bounce from those levels back, mean reversion back to the 69.70, 69.80 by the end of the day. But as of now, it seems bullish. And as long as the market holds 69.85, 69.80, as long as it holds that level, the market can go only up. And I wouldn't be surprised again if it goes up 7,025. At least trade it one time by the end of the day. That is, as long as we hold 69.80. That's pretty much it.
Yeah, that's might be a bridge too far, but maybe not. I'm actually curious to see something. So one of the things you could do with options that I like is if I put on markers, we could see what the intraday trading is. So I want to see if if there was people buying the 85 calls, and again, it doesn't have to be whoever sold 2,500 of these calls that's buying them back. It could be, now that Chewy left, it'd probably be Vol Trader who's buying 5,000 of these calls that would then just flip this bar the other way. And we saw that yesterday happen at 75, whatever. It happened at one of the potential ceilings that ended up becoming a ladder up, a positive gamma ladder up. So far the structure is staying intact here.
By the way, what is that level? Just can you go down 2 levels, 2 strikes? No. Just where you were. Now go up 5 strikes, 5 bars.
Here, this one?
Yeah, just underneath that.
69.70.
Just underneath that. Wait, just underneath that level, basically 69.65 seems that it left like it was positive and it became negative.
It went from positive to negative. Yep.
And this happened today.
This happened probably in the last 15 minutes.
I guess those were monetized on the CPI.
Probably, yeah. Probably calls monetized on the CPI.
Yeah, you have a lot of calls. You have a lot of them. Look at how many strikes were positive.
If we want to see what's actually sitting there now at 69.70, what's sitting there now?
No, we were talking about 69.65.
Well, 69.65 is basically an echo of 69.70. Both of these, this whole cluster, let's call it, 70 down to 60 is customer long puts, market maker short. So some puts came in.
The previous screen that you just showed,
the money.
But the previous screen that you just showed, that shows the residues of where things were and how they're looking now.
Right.
So these, I can see it on my end. These are basically, as the CPI came out, they just monetized those calls heavily. That's what generated that pullback. That's it, that initial pullback.
They did both. They monetized those calls and bought some puts. I mean, different market maker, but different participants probably,
Well, that could be just synthetic futures. So if you're selling your calls into a synthetic future, you'll get that simultaneously.
That's true too.
So well, it's hard to call that for the remaining of the day, but obviously they saw that as an opportunity to take profits against that large CPI spike. I guess we go back up there. The market will try to go back up there, right? Because they did create, they did give you a hint as to where the market is valued post CPI. And when the real session starts, that repricing of the SPX following the CPI should come through again. But I still think it's a bit, it's interesting that they immediately monetize their calls, right? Immediately.
Now, if we look up here, just a little bit, some 70-10s. Let's just say that it wasn't the people who were short the 70-10 who bought them back. Doesn't really matter. Customers are starting to nibble in here. Customers are starting to monetize up here, nibble around.
The only one that is kind of standing out is that put at 7,005. That put, that thing, which was much larger and was also monetized or closed or whatever.
Yes.
Yeah, that's the only one that stands out, which is kind of hard to interpret, versus the calls, which were all monetized, which makes sense. You got a nice spike, so they sold. This put is a bit strange.
And so, folks, this is what we try to do as much as we can, running commentary in the room. I'm a pretty active trader. 50 trades a day is a slow day. And so between the trading and me narrating it and vol trader or somebody else jumping in or other people. We do the best we can to keep our eye on the flow. It's 10-minute slices. And so there might be this might have happened 10 minutes ago or 10 minutes before this happened or 2 minutes before, we don't know. And the initial hedging is already done, but we still know what's in the dealer's hands until the next cards get done. And that's what we try to use as an edge on top of TA, on top of whatever else you use, on top of, yes, Selena's observation is correct. The 705 was longer. And that's what we try to do, to sell credit spreads, buy butterflies, scalp, also look at positioning out in time. So let me go take a quick look here. So let's look at the 16th. Let's look at the monthly, at the MOPEX. 70-75 sold calls, 70-60 sold calls. Kind of got a little bit here at 7,000, and you kind of have a ladder up. The red is market maker short, customer long. You kind of have a ladder up this way, not saying we get there. And locally, there's not a lot to there's some supportive gamma, but these aren't huge numbers. See, the bigger numbers are obviously in the AM expiry. So really, let's look at the AM expiry. 70-55 looks like institution might have sold a 5 wide up here. 7,000, they're long, and they've been sitting there for a long time. 60-50, we got more puts than calls there at 60-50, so there's bearish bets at 60-50, and down below, the next really big level is 68-20, but it's basically supportive all the way, to it. And I'm gonna wrap it up with this. I just want to show you something else. So I like to do weekly iron conduits as well. And so here's what the magic, whatever it is that marks the expected move here on the chart. And this is Friday to Friday. So this appeared on the chart Friday morning. And what was it? 68.85, whatever it was. Remember, that was Friday we made that all-time high. 68.85 was the bottom of the expected move. 70.50 was on top. Still looks like that'll probably be respected. So I like to go at least 1.5 away from the expected move. So
1.5 what? 1.5 what?
And sell iron conduits.
No, but when you say you like to go 1.5 wider, you mean what? Percent, points, what?
Like standard deviation. So that would be roughly a 10 delta.
Now, when can you rely on this? So when do you set up your iron condor? Right off Monday or after the week opens?
Okay, so I'll tell you, I do an initial small tranche in the morning when I get this on Friday morning. Then Friday after the close, I may add or adjust it. And then Monday, I'll kind of fill it out. And so, for example, Friday, when we were at the all-time high, I sold the calls. I maybe sold 1 or 2 puts down here because I don't want to get in at the all-time high, and sell the put. So yesterday, when we at the open, was a perfect time for me to fill out the put portion, and I got decent juice down in the below 6,800 area. And now I will use this as part of my guideline for selling my weekly iron condors, but I will combine that paying probably more attention to what's going on in the chain for next Friday. If I see, if let's just say hypothetically, the expected move tells me go over here, and I see a ladder of customer long dealers short leading up to there, sorry, thanks, but no thanks. And same thing on the bottom. So I want as much confluence as I can get between the gamma structure telling me where we quote unquote should go, where the guardrails are conditionally, and where the expected move is. And that's kind of what I try to do.
That's very interesting, and a smart way of utilizing both, both data points. Obviously, just sticking to the expected move is a simplified way of doing it and hoping it will work out. But yeah, it's a nice touch with the structures here. And what's the premium that you generally can get a week out? Like you start Monday into Friday, so that's five days out.
It depends on how wide you go, but it's pretty easy. Let's say if you go 15 or 20 wide, to get between, I don't know, 75 cents and $1-ish.
On a 5 wide, on a like you do an iron condor.
On a
Yeah,
15 wide,
the iron condor legs are 5 wide. Yeah.
you know, like more like 10 to 15 wide. 5 wide, you're going to have to go closer to about a 15 delta, 12 delta.
No, I mean the distance between the strikes. You sell a call and buy another call. Those are always
right.
5 wide.
Like 10 or 15 wide, you have to go to get decent premium, to get like 75 cents a buck, If you want to go 5 wide, you're either going to have to settle for 40, 50 cents or go closer. And then you have to kind of really titrate where these levels are. Now, that said, some of the subscribers, I know Selena in particular, does 5 wides and does fine with them. So you could do a 5 wide. You just have to, put the little extra, what do I want to call it? A little extra care in figuring out where you're going to go. That's all.
So for today, where are you positioning your flies intraday?
Excuse me?
Where are you positioning your flies today? For today, 0 DTE.
Oh, for my strike for today? Good question. Let's take a look. Actually, that's a question I have for myself. So let's take a look.
Yeah, you didn't show us the position for today.
Yeah, so let's take a look. So for today, I really don't have anything. I have like a few call spreads up at 70-40, like 2 or 3 of them. And I had that butterfly, I guess I was looking at. I don't know what happened to it, canceled. So where are we now? Oh, that was okay. So here's where we are now. So what am I looking at for today? Off the top of my head, well, we know we have all that positive gamma area down below. So let's just look at wow, 90 cents. That's pretty juicy. Okay. Let's see what 35, 60 cents. I like that. I would do that. And I would add. I take 60 cents for that right here, right now. Oh, I guess I do have some stuff going on here. Oh, I guess the screen didn't refresh. This is filled. Okay, I see. Yeah, so I think that's fine on the bottom, below 50. Expect a move of 28. We're at 80-ish. And on top, see, the top is tricky. And I sold the 25s and 30s and 35s yesterday. I closed most of them. Do I want to be at 25? Gun to my head, maybe, but I'd much rather be a little further. I'd much rather be here 30. And so what I do is I'll put it in at 50 cents for now and see if I can get it on the way up. We probably don't go much past 15. But I want to see the positioning before I take the upside.
Now, how do you manage P&L wise? I mean, you have a downside that costs you that gave you 60 cents, right? And you have the upside gave you, let's say, will fill at 50 cents. Now, as the market goes up, you don't care about the put side anymore, right? You just let it die. You get your 60 cents, and then you only manage the side that is being attacked, right?
Right, so if the market goes up, I might do one of a few things. I might sell more of the calls, getting a higher premium if I feel good about it, so to speak. Or I might say, you know what? This looks a little nasty. I'm gonna do this and turn it into a fly, and my debit is X, and my is X, and my credit is Y. So the most I have in this trade is whatever. So I turn it into a tighter defined risk, trying to still keep a credit, and then maybe monetize this on the way up or not, just kind of depending. I could do a few things.
Yeah, also, so you would buy in this example, you would buy the 70-20 before we hit 70-20.
Yeah, I might. I'm just thinking off the top of my head.
Yeah. So like a hedge, basically. You turn it into a butterfly. Yeah.
Yeah, so I could turn it into a fly. I could use it as a hedge in front of it. I could do the arithmetic and say I'll just make up a number, 75 cents for what I sold. And I paid 45 cents for what I bought. That gives me a net credit of 30 cents. And if it's equal, if I can get that where it's equal, say on a pullback, then that's the most I could lose. If it's still broken to the upside, we're a wider wing on top, then I have to do the arithmetic and see what my loss is potentially, but it greatly reduces it if I'm afraid of a crazy run to the sky.
Yeah, I mean, you make it sound very easy. There's a lot of experience guiding you as to which strike to buy, ditch it altogether, or turn it into a fly. All those things that you do in real time. It's pretty awesome. Yeah.
Yeah, I mean, it becomes easy after 10,000 repetitions. It's getting warm in here. I had the heater on in here, and now it's warming up. Okay, I'm gonna 9:20. Time to figure out how we're gonna make some money today. Thanks everybody. And one last look. Hold on. Let's take one last look at options depth. See, remember we saw the snapshot before. Let's see what's going on now. Okay, so it looks like 7,000s are closing, not opening. Well, we don't know if they're closing, but there's less there than there was, so it's less of a magnet.
What's the breakdown there? How many calls are bought, sold? What's the breakdown there?
So it was whatever it was. It was 2,000, whatever was there, and now it's okay.
But these are short calls or short puts. What are they?
These are. We can go right in here and see exactly what they are. These are customers long, 2,300 calls.
Okay, so the market maker is short the calls. Okay, got it.
And customers actually sold 7,000, sold 400 puts at 7,000. We got sold puts at 7,000. Part of some kind of synthetic trade, whatever. You know about that stuff better than me. You were a market maker, so you have a better feel for how people do synthetics. Since that's not something in my world to do, I don't have that kind of money. It's not something I really, have experience. I might have done it sometimes with SPY or with little things just for fun. So here we could see what's actually in the dealer's hand at the moment or as of 10 minutes ago or less.
Yeah, this shows the breakdown of the bars that we look at.
Right,
So when
right. So
when those
when
blue bars go negative, we don't know right away if that is short calls or short puts. But here we get the picture.
right. So here we can actually see, what's there.
Yeah.
So this is customers. This is market makers are short 2388 calls, so that means customers are long that many, et cetera, et cetera. Down here below 70, we have some puts. It's not a huge number, but of course, if we break 75 and start going down, this could matter. These are
Yes,
small numbers,
today
500.
the positions are pretty thin because
Yes.
naturally a lot of investors take off stuff before the CPI, and they don't
Yes.
they don't want that exposure before the news.
Yes.
But to the upside, clearly a bullish tilt from customers' perspective, being long calls all the way up from 7,000 till 725. I think I saw all that red bulk. Yeah, all that red cluster, other than 7,010, these are basically long customer calls. So short market maker.
Up here at 7020, we have long calls.
Yeah.
At 7025, we have short. So we could pretend that's a debit spread. We can pretend that's a debit spread over here. 70, 20,
spread.
70,
Oh yeah,
20.
from a customer perspective. Okay, yeah.
Yeah. Oh, and I guess I'll make a last educated to trader. That's exactly the way I think. The top is tricky. Wait till it stalls and runs. See what comes in, and then kind of pick your poison. Yep. All right, I'm going to run. Thank you, Val, for the interesting discussion.
Thank you.
Like, subscribe, everybody, all that good stuff, and trade safe.